Picture two couples retiring on the same day. Same $1.5 million, same Social Security benefit, same zip code. Run that household through a retirement tax model for 15 years using two different withdrawal strategies, and the numbers split hard. One couple, using the default spend savings first approach, ends up paying roughly $600,000 in lifetime taxes. The other, using a specific withdrawal sequence, pays around $210,000. Same net worth on day one. Same lifestyle the whole way through. The entire gap comes from one decision almost nobody makes on purpose. The order money leaves your accounts. This isn't a fringe idea. Vanguard's own advisor's Alpha Research, the study the firm uses to quantify which planning decisions actually move the needle for retirees, names tax-efficient withdrawal sequencing as one of a handful of decisions worth a measurable ongoing return advantage separate from investment selection entirely. And the specific danger of ignoring it has a name in financial planning literature: the tax torpedo, a term that grew out of research into how Social Security taxation interacts with other retirement income. Most retirees have simply never been shown the framework behind either finding. By the end of this video, you'll have that framework. I call it the bracket ladder, and we're covering three things almost no retirement video touches: a stock option rule that can quietly save tens of thousands of dollars, a Medicare trap that's cost real retirees 5 figures without them realizing why, and a tax cliff that hits surviving spouses at the worst possible moment. If you've seen the 3 buckets, do a Roth conversion video before. Stick around, because this goes further than that. Think of your tax brackets as rungs on a ladder. Every year in retirement, your job is to fill the bottom rungs deliberately. Never let the calendar shove you straight to the top. The tax code taxes income in slices. As of current brackets, the 10% and 12% federal brackets have significant room in them for most retirees, often tens of thousands of dollars of space that goes completely unused. Most retirees leave that space empty by living off savings that generate no taxable income, and then get forced into much higher brackets later by mandatory withdrawals. That's the exact problem this video solves. There's actually a behavioral reason this happens, and it's worth naming. Most people treat not touching retirement accounts as inherently safe because it feels like preserving the nest egg, but tax exposure doesn't pause while an account sits untouched. It grows right alongside the balance. The instinct to protect the account is precisely what expands the future tax bill. Planners call the fixed bracket filling or tax bracket smoothing. Call it the bracket ladder. You climb your own income up, one rung at a time, on purpose, instead of getting shoved up several rungs at once by required minimum distributions. Every tool in this video is a way of building or climbing that ladder. Now let's look at where your money actually sits. Most videos on this topic stop at 3 buckets. There's a fourth, and it's the one people waste the most. Bucket 1 is tax deferred. Traditional 401k, 403b, traditional IRA. Deduction going in, ordinary income tax coming out. Bucket 2 is tax-free. Roth IRA, Roth 401k. Taxed going in, untaxed forever coming out, and no forced withdrawals during your lifetime. Bucket 3 is taxable brokerage accounts. No deduction going in. Capital gains tax on growth coming out. And one detail almost never mentioned: if you die holding appreciated stock in this account, your heirs inherit it at its current market value for tax purposes. The embedded gain simply disappears. That single rule changes which assets are smarter to spend, down first versus hold, until death. Bucket 4, the one people forget entirely, is the health savings account. After age 65, you can withdraw HSA funds for any reason, penalty-free, and just pay ordinary tax, exactly like a traditional IRA. But withdrawals for qualified medical expenses at any age are completely tax-free. Since nearly everyone has medical costs in retirement, a well-funded HSA works like a stealth Roth account that most people accumulate by accident and then withdraw from badly. Here's a question worth sitting with before we go further. If these 4 buckets are taxed so differently, why does almost every retiree draw from them in the exact same order, regardless of their situation? Keep that question in mind. The answer is going to change how you think about the next 12 minutes. The common advice is spend the taxable account first, leave the tax-deferred and Roth accounts alone as long as possible. It sounds disciplined. It's actually how people trigger the tax torpedo effect we referenced at the start. Leave a traditional IRA untouched for a decade, and by the time RMDs begin at age 73, the balance has often grown substantially, and the IRS now forces a percentage out every year calculated off that larger balance. That forced withdrawal can jump a retiree from the 12% bracket straight into the 22 or 24% bracket in a single year, purely from letting the wrong account compound untouched for too long. It compounds on itself, too. That surge of RMD income pulls more of your Social Security into taxable territory, can trigger Medicare surcharges, and can push your capital gains rate from 0% to 15%, all in the same tax year, from one withdrawal event. This is precisely the interaction the tax torpedo research was describing. It's not one tax going up, it's several tax mechanisms firing off the same trigger simultaneously, answering the question from before. The reason almost everyone draws from accounts in the same default order isn't strategy, it's inertia. The same behavioral pattern that makes people leave a 401k in its default fund allocation for decades. Nobody actively chooses the tax torpedo. They just never actively chose anything else. The fix. Don't wait for the IRS to force your hand. In your low-income years, which we're about to define precisely, deliberately withdraw enough from the tax-deferred bucket to fill the bottom rungs, even when you don't need the cash, and move what you don't spend into a Roth. You're choosing your bracket instead of having it chosen for you at a worse rate. Later, this is the highest leverage move in the framework. Say you retire at 62 with a small pension of $20,000 a year. For a married couple filing jointly, after the standard deduction, the 12% federal bracket currently has room up to roughly $96,000 of taxable income. That's tens of thousands of dollars of bracket space sitting unused every year you don't fill it. A Roth conversion means withdrawing from your traditional IRA specifically to fill that space, not because you need the cash, paying the relatively low tax now and letting that money compound tax-free forever in a Roth with no future RMDs attached to it. Compare that to doing nothing. At 75, with Social Security, a pension, and mandatory RMDs stacked together, that same household could land in the 22 or 24% bracket. Converting those same dollars now instead of being forced to withdraw them later can mean paying roughly a half the tax rate on identical money. 3 execution rules. First, convert in slices across multiple years, filling the bracket without spilling into the next one in a single year. Second, if you're not yet on Medicare, watch how a conversion affects marketplace subsidies. If you are on Medicare, watch IRMAA, covered in a few minutes. Third, pay the conversion tax from your taxable account rather than withholding from the IRA itself, so the full converted balance keeps compounding tax-free. This window between retirement and the year RMDs and Social Security both begin is usually the cheapest tax rate you'll see for the rest of your life. Miss it, and you pay full price on the same money later. If your 401k holds a meaningful amount of your own company's stock, most people roll the entire account into an IRA automatically. That default can be expensive. The alternative is a one-time election called Net Unrealized Appreciation, or NUA, a provision that's existed in the tax code for decades but rarely gets explained outside specialized retirement planning circles. Instead of rolling the company's stock into an IRA, you move it into a taxable brokerage account. You pay ordinary income tax now, but only on the stock's original cost basis, not its current value. Every dollar of appreciation above that basis is taxed later at long-term capital gains rates instead of ordinary income rates, even if you sell immediately. Here's what that looks like in practice. Say your cost basis in that stock is $50,000, and it's now worth $300,000, $250,000 of embedded gain. Rolled into an IRA, every dollar of that $300,000 eventually comes out taxed as ordinary income, potentially at rates as high as 22 or 24% or more. Using the NUA election instead, you pay ordinary tax only on the $50,000 basis now, and the $250,000 of appreciation is taxed at long-term capital gains rates, commonly 15%, when sold. On appreciation that size, the difference in tax owed can run well into 5 figures, and most standard rollover paperwork never raises the option. Most content treats Social Security timing purely as a break-even age math problem. Here's the piece that's usually missing. Up to 85% of your Social Security benefit can itself become taxable based on a formula combining your other income with half your benefit. Every dollar you withdraw or convert from a traditional account can pull more of your Social Security into taxable territory in that same year. The buckets are never independent. This is, in fact, the exact mechanism the tax torpedo research was built around. Delaying benefits from 62 to 70 grows your check by roughly 8% a year past full retirement age, a guaranteed, inflation-adjusted increase unmatched almost anywhere else. It also keeps Social Security off your tax return during the exact years you're trying to fill low brackets with conversions. Delay the benefit, use the gap years to convert, and let a larger check arrive later once less of your income comes from sources that can be taxed at will. There's one more piece. almost nobody covers. The survivor's tax jump. When a spouse passes away, the survivor moves from filing jointly to filing single, often the very next tax year, while usually keeping only the larger of the two Social Security checks and roughly the same portfolio income. Single filers hit each tax bracket at close to half the income level of joint filers. That means a surviving spouse can land in a meaningfully higher bracket the year after losing a partner, with no change in actual spending. Doing more aggressive Roth conversions while both spouses are alive and filing jointly is one of the most overlooked ways to soften that jump before it happens. IRMAA is the Medicare premium surcharge, and it catches people two specific ways. First, it's based on your tax return from 2 years earlier, so a large Roth conversion or withdrawal today can quietly raise your Medicare premiums 2 years from now, long after the decision is forgotten. Second, it works in cliffs, not gradual steps. Cross a threshold by even a small amount, and you can be bumped into a materially higher premium bracket for the entire year on your entire income, not just the amount over the line. That single-dollar cliff has genuinely cost retirees thousands of extra dollars in Medicare premiums from a withdrawal made 2 years earlier for something as ordinary as a home repair. The fix: before any large one-time move, a big conversion, a big capital gain, a big withdrawal, check the current year IRMAA thresholds first. Sometimes the smarter play is spreading that same withdrawal across 2 tax years specifically to stay under the line. A few more tools that stack on top of everything above. Qualified charitable distributions let you send money directly from your IRA to a qualified charity once you're 70 and a half or older, up to a limit that's indexed for inflation each year, and it counts toward your RMD without ever showing up as taxable income. It's one of the most tax-efficient ways to give charitably in retirement. Asset location matters as much as asset allocation. Tax-inefficient holdings like bonds generally belong in tax-deferred or Roth accounts, while tax-efficient index funds tend to fit better in taxable accounts. Same portfolio, different placement, less tax drag every year. Medicare Part D has its own coverage gap, sometimes called the donut hole, where prescription costs can spike unexpectedly in certain income years, worth checking before a large conversion if you're on multiple medications. And qualified longevity annuity contracts let you move a portion of a traditional IRA into a deferred income annuity that's excluded from RMD calculations until payouts begin later in life, shrinking your forced withdrawal base during the exact years the tax torpedo does the most damage. Here's the twist worth sitting with. None of these tools work in isolation, and one badly timed move can undo the benefit of all the others. Convert too aggressively in 1 year, and you can trip an IRMAA cliff 2 years later. Delay Social Security without converting during the gap years, and you waste the cheapest tax rate you'll ever see. Roll company stock into an IRA on autopilot, and NUA is gone for good. It's a one-time election. The bracket ladder only works as a coordinated sequence, which is exactly why Vanguard's own research treats withdrawal sequencing as an ongoing decision worth revisiting every year, not a one-time choice you set and forget. That's the real thesis here. Don't let the calendar decide your tax bracket. Decide it yourself, one rung at a time, long before the IRS forces the issue. None of this replaces sitting down with a fee-only fiduciary planner or CPA who can model your specific numbers. This framework tells you which questions to bring to that conversation. Tax figures referenced here reflect current brackets and limits, which are adjusted for inflation each year, so confirm current year numbers before acting. If this gave you at least one thing you hadn't heard before, that was the goal. Subscribe. Next up is a full dollar-by-dollar case study, running one household through the entire bracket ladder. Drop a comment with which piece you want modeled first, and I'll see you in the next one.